Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Mohammad Haque, and we are going to start our lecture in strategic management, and we will cover some topics in strategic management as we were learning before in the classroom. But you know very well nowadays the world is facing such kind of a problem regarding coronavirus, and so all the universities are going towards the online teaching. So it is also one of the efforts from the teacher that they are doing the online teaching now. So I am also recording this lecture for the purpose that you all people can learn more, and even in any place you can go to my YouTube channel. Just you have to go to the YouTube, www.youtube.com, and then search Syed Muhammad Riazul Haq, and then go to the playlist. In the playlist you will find the subject strategic management. You have to press the strategic management, and then you will see the videos regarding some topics of the strategic management that we are going to start today. So in today's lecture, we will discuss about the internal assessment. As in a strategic management course, we have a strategic management process, and in this last time we were talking about internal assessment. We have already done some subjects, some topics. So today we are going to start the internal assessment. In internal assessment we have done many topics, so we are going to learn about finance and accounting, how the strategist basically know about the current positions of the firm or of an organization regarding their finance and accounting purpose. Determining the organization's financial strength and weakness is essential to effectively formulating strategies. A firm's liquidity, leverage, working capital, profitability, assets utilization, cash flow, and equity can eliminate some strategies as being feasible alternative. Financial factors often alter existing strategies and change implementation plans. So you see that it has a very much effect on the decision making process when a strategist or the board of director and the top management decide to do a new thing. So first of all, they should know about the current positions of the financial current position of the firm regarding finance. So in today's topic we are going to discuss about 2 and 3 things like finance and accounting, and finance and accounting functions, and then we will also discuss about some financial ratios, that what kind of ratios we should know to evaluate the current positions of the organization or of a firm, whether it is going a right way or a wrong way. Because the internal assessment is basically the part of the strategic formulations. It is a part of the strategic formulation. So we have to formulate the strategy and see what is the effect of the implementation or not. So now we discuss about finance and accounting functions. So according to James 1, the functions of finance and accounting comprises 3 decisions: the investment decisions, the financing decisions, and the dividend decisions. Financial ratios analysis is the most widely used method for determining an organization's strength and weaknesses. Now we talk about the investment. Now we talk about the investment decisions. The investment decisions, also called the capital budgeting. Basically, it is the allocations and reallocations of the capital and resources to project, products, assets, and division of an organization's. Once strategies are formulated, capital budgeting decisions are required to successfully implement strategies. The financing decision determines the best capital structure of the firm and includes examining various methods by which the firm can raise capital. For example, by issuing stocks, increasing debt, selling assets, or using a combination of these approaches, means you using the combination of selling assets and increasing debt, or whether issuing stocks and selling assets, they can use the combination of these three, or they can go to one by one, or they can implement all of three categories. So the financing decision must consider both short-term and long-term needs for working capital. Two key financial ratios that indicate whether a firm financing decision has been effective are the debt to equity ratio and the debt to total asset ratios. So they are the two, debt to equity ratios and debt to total asset ratio is very compulsory. So well, now we talk about the dividend decision. So as far as the dividend decision concerns, it concerns basically issues such as the percentage of earning paid to stockholders, the stability of dividend paid over time, and the purchase or issuance of stock. Dividend decision determine the amount of funds that are retained in firm compared to the amount of paid out to stockholders. Here, three financial ratios that are helpful in evaluating a firm's dividend decisions are the earning per share ratio, the dividend per share ratio, and the price earnings ratio. These three ratios, you know very well, as you also studies the financial management. So such kind of financial ratios, you should know about how to calculate them and what it measures. Inshallah, today we will also take a little brief introduction about these ratios. Some companies do examine the firm by means of such ratios. They use some kind of liquidity ratios, profitability ratios, growth ratios. So 20, 22, 16, 18 types of ratios they calculate and find out the current positions of the firm, where the firm stands and an organization stand, and how can they do more things, how can they develop a more good strategies for the purpose of getting more success in the business. So as a strategist, and being a strategist, you should know, as a students of the MBA or a BBA, you are learned many subjects like finance, marketing, productions, statistics, research methods. So if you are a strategist, it means you are working in a higher position in an organization. So you must know and how an expertise in finance management, financial reporting, how to write report, and how to evaluate a firm, and how to make a decisions and implement it, and how to find the current position of an organizations. So for this purpose, you should know and at least understand some basic fundamental finance ratio that evaluate the current positions of the firms. That is very useful for making new strategies or for formulating the strategies for the success and progress of any organization of the firms. So here we again talk about, now we discuss about little introduction about some financial ratios like liquidity ratios. When we talk about the liquidity, it means when we talk about the liquidity of a firm, so normally it means that how if you say the firm is more liquid, it means that the firm is so much capable to convert its finished goods to the cash. If an organization or a manufacturer converting its goods to the cash, it means selling its goods and converted it to the cash. So it is more liquid. So we'll discuss here some fundamental ratios. So first we have here in liquidity ratios. When we talk about the liquidity ratios, just we have a here look as an introduction level. First of all, we have a current ratio. Current ratio, what is the formula of the current ratio? If you want to find out the current ratio equals to current assets divided by current liabilities. And what basically it measures? It measures basically the extent to which a firm can meet its short-term obligations. What the extent to which a firm can meet its short obligations. So And you know very well what is the short-term obligations, basically to pay liabilities, to pay the bill and utility bills, and perhaps some kind of account payable that need to be paid. So the current assets tell us about this, the current ratios. Second, we have in a liquidity ratio that a quick ratio. Quick ratio, how can you find out the quick ratio? If you divide current assets minus inventory, first of all you have to do this, current assets minus inventory. You have to minus inventory from the current assets. Whatever the answers comes, you have to divide from current liabilities. So it is the formula of the quick ratio. And what it measures, basically it measures the extent to which a firm can meet its short-term obligations without relying upon the sale of its inventories. That is an important point. Without relying upon the sale of inventories, the extent to which a firm can meet its short-term obligations without relying upon the sale of its inventories. So here are some, now we talk about the leverage ratios. In leverage ratios, we have first of all debt to total asset ratio, and you can calculate it by dividing total debt to total assets. So debt to total assets ratio equals to total debt divided by total assets, and it measures the percentage of total funds that are provided by creditors. In leverage ratio, we have a debt to equity ratio. You can find out that to equity ratio is equals to total debt divided by total stockholders equity. And what it measures, basically it tells you the percentage of total funds provided by creditor versus by owners. Third, we have here the long-term debt to equity ratio. So you can calculate it, long-term debt to equity ratio is equals to long-term debt divided by total stockholders equity. And by this formula, what you will know, basically you will know what the balance between debt and equity in a firm's long-term capital structure. That tells the balance between debt and equity in a firm's long-term capital structure. The fourth one is the last leverage ratio. We can say that here times interest earned ratio, and it is equals to profits before interest and taxes. Whatever the result comes, you have to divide total interest charges. So the time interest earned ratio is equals to profit before interest and taxes divided by total interest charges. And whatever the answer comes, basically what it tells you, it is very important to know what it tells you, what it defines, what it measures. Basically it measures the extent to which earnings can decline without the firm becoming unable to meet its annual interest costs. So here we have other ratios like activity ratios. So in activity ratios, we have a first inventory turnover. You can calculate inventory turnover by dividing the sales to inventory of finished goods. So we can say that the formula will be like this: inventory turnover equals to sales divided by inventory of finished goods, and it measures whether a firm holds excessive stocks of inventory and whether a firm is slowly selling its inventory compared to the industry average. The next we have fixed assets turnover. You can calculate it. Fixed assets turnover equals to sales divided by fixed assets. What it tells? It tells basically it measures sales productivity and plant and equipment utilization. Next we have total asset turnovers. Total asset turnovers equals to sales divided by total assets, and it measures whether a firm is generating a sufficient volume of business for the size of its assets investment. So the next ratio in activity ratio, we have account receivable turnover. Account receivable turnover is equals to annual credit sales divided by account receivable, and it measures the average length of time it takes a firm to collect credit sales in percentage term. What it measures? The average length of time it takes a firm to collect credit sales in percentage terms. Average. Then we have an average collection period. Average collection period equals to account receivable divided by total credit sales divided by 365 days. Then we will find out for a 1 day. And what it measures basically the average length of time it takes a firm to collect on credit sales in days. So here are these. So far we have talked about 1 2 3 4 5 6 7 8 9 10 11, and there are others ratios, financial ratios that are strategies, and there are other financial ratios that as a being of strategies you should know how to calculate it, and basically what the meaning of these ratios. We have discussed so far about the liquidity ratio and activity ratio like this. So as a decision maker, whatever comes out to find out these ratios, and you should know how to analyze the company's situation or a firm situations after doing such kind of calculation. So let's talk about profitability ratios. So in profitability ratios, we have number one, the gross margin ratio. So the gross profit margin, you can calculate it sales minus cost of goods sold divided by sales, and it measures the total margin available to cover operating expense and yield a profit. Second, we have in our profitability ratio is operating profit margin. Operating profit margin is equals to earnings before interest and taxes. We can say EBIT, earning before interest and taxes, divided by sales, and it measures profitability without concern for taxes and interest. Similarly, if you want to know the net profit margin, so net profit margin is equals to net income divided by sales. It's so easy, and it measures basically after tax profit per dollar of sales. After tax profit per dollar of sales. Return on total assets. We also say ROA, return on total assets, is equals to net income divided by total assets, and what it measures after tax profits per dollar of assets. This ratio is also called the return on investment, ROI. Next we have return on stockholders equity, ROE, net income divided by total stockholders equity, and it measures after tax profits per dollar of stockholders investment in the firm. Earning per shares, EPS, you can calculate earning per shares by dividing net income to number of shares of common stock outstanding, and it measures earning available to the owners of common stock. And the last ratio of the profitability ratio is the price earnings ratio. The price earnings ratio is equals to market price per share divided by earnings per share, and it tells you about attractiveness of firms on equity market. So the last we have the growth ratio. In growth ratio we have a sales, and sales, how can you calculate the sales? Annual percentage growth in total sales, and it tells firm's growth rate in sales. And second, net income, then you can calculate net income like annual percentage growth in profit firms, and it tells the firm's growth rate in profits. Sales, firm growth rate in sales, and firm's growth rate in profit. Earning per shares can be calculated like annual percentage growth in EPS, annual percentage growth in EPS and earning per shares, annual percentage growth in earning per shares, and it tells you about firm's growth rate in earning per share. So the last we have dividend per share, that can be calculated like annual percentage growth in dividend per share, and it tells firm's growth rate in dividend per share. So basically this financial ratio analysis must go beyond the actual calculation and interpretations of ratios. The analysis should be conducted on the three separate forms, three separate fronts. Like we have questions like that: how has each ratio changed over the time, and how does each ratio compare to industry norm, and how does each ratio compare with key competitor. And we talk about the how does each ratio change over the time. This information provides a means of evaluating historical trends. It is important to note whether each ratio has been historically increasing, decreasing, or nearly constant. For example, a 10% profit margin could be bad if the trend has been down 20% each of the last 3 years, but a 10% profit margin could be excellent if the trend has been up. Therefore, calculate the percentage change in each ratio from 1 year to the next to assess historical financial performance on the dimension, identify and examine large percentage change in a financial ratio from 1 year to the next. And the second question we have, how does each ratio compare to industry norms? A firm's inventory turnover ratio may appear impressive at first glance but may pale when compared to the industry's standards or norms. Industries can differ dramatically on certain ratios. For example, grocery companies such as we have a different companies in other areas like in America we talk about like this, or other foreign countries like such as Kroger have a high inventory turnover, whereas the automobile dealership have a lower turnover. Therefore, comparison of a firm's ratio within its particular industry can be essential in determining its strength and or weaknesses. And the last question that we should have to analyze the ratios is, how does each ratio compare with the key competitors? Oftentimes, competition is more intense between the several competitors in a given industry or a location than across all rival firms in the industry. When this is true, financial ratio analysis should include comparison to those key competitors. For example, if a firm's profitability ratio is trending up over time and compares favorably to the industry average, but it is trending down relative to its leading competitors, there may be reason for concerns. So here we can say that these financial ratios it's about 22 financial ratios that is very helpful for a strategist to formulate a new strategies to find out the current position of the firm and how to take a decision, and it is useful for making a decision. So in strategic management, or as a strategist, you should know how to deal and how to analyze such kind of ratios and what it tells. The most important thing is that you know the formula, you know how to calculate it, but whatever the results come, basically what it interprets, that you should know what it measures. You have to understand this, what it measures, and if you know the what it measures, then you can analyze in a better way, in a more clear way, and it will very helpful to formulate a good strategies. Now look out some checklist when we want to make evaluate a financial conditions or financial accounting functions. So we have also some financial accounting audit checklist. So what things should be added in the financial accounting audit checklist? So number one, we have where is the firm financially strong and weak as indicated by the financial ratio analysis. So you have to find out in your audit checklist where is the firm's financially strong and weak as indicated by the financial ratio analysis. Number two, we have, can the firm raise needed short-term capital? Number three, can the firm raise needed long-term capital through debt and or equity? Number four, we have does the firm have sufficient working capital? Are capital budgeting procedure effective? Are dividend payout policies reasonable? Does the firm have good relations with its investor and stockholders? Are the firm's financial managers experienced and well trained? So today in this we just talk about these finance and accounting functions, and financing decision, investment decisions, dividend decisions, and how to analyze the firms by means of some fundamental basic ratios that the research and development department, or we can say the strategists or the top management's policy makers and those who are involved in making a strategies for the organizations take these tools, these ratios, these financial ratios, liquidity ratios, activity ratios, profitability ratios, like growth ratios. So such kind of ratios tells the strength and weakness of the firm. And as we have also heard and listened, that we have understand that there is also the audit checklist for evaluating the finance and accounting functions. So these are the 5, 6 and 7 questions we have to put in the mind as a strategist to evaluate a firm's positions, to make a better or to formulate a better strategy for the futures. So I hope you understand this, and if you have any question and queries, soon I will tell you my Facebook page also. So you can also give some comments and ask the question there. And I have a request to all of you to please subscribe Syed Mohammed Riazul Haq, that is I, and to share it, like it, and contact this one. And also some assignments and other things and tasks will be given to you, and you have to also log on to your online account in your university that they are using the Zoom. So I'm requesting you to be update, and I pray and say that all of you be safe, stay safe, may God protect us, and inshallah we as a human being will defeat this coronavirus by our will, by our faith, and by our belief, and by practicing and saving, and whatever the doctors of your country say, some precautions, so you have to adopt them. And don't be panic, don't worry, by the grace of Allah we will defeat it. It is an exam for us, we have to fight it and we have to win it. Inshallah, meet you with another topic. I hope you like it. Goodbye, have a nice day, stay safe, Allah Hafiz.